What do Apple, Tesla, and Coca-Cola all have in common beyond being global giants? They don't just sell great products, they make exceptional financial decisions. Every major move, launching a new product, opening a factory, borrowing money, or paying dividends, flows through one core function: corporate financial management. This is the Learning Studio, and today we're breaking down how companies manage money, strategy, and risk, where numbers stop being records and start becoming decisions. At its core, corporate financial management is about value, not short-term profit, but long-term survival and growth. Every company faces three unavoidable questions. Where should money come from? Where should it be invested? And once profits are earned, should they be reinvested or shared? Take a company planning a major expansion. It can raise money from investors, borrow from lenders, or use its own reserves. Each option has a cost, a risk, and long-term consequences. Borrow too much and risk collapse. Rely only on equity and dilute ownership. That balance between debt and equity quietly shapes a company's future. Strong firms manage it deliberately. Weak ones drift into it by accident. But even well-funded companies fail if they can't manage day-to-day cash. A business can look profitable on paper and still collapse if cash doesn't arrive on time. Inventory sitting too long, customers paying late, bills due now. This is where working capital management keeps companies alive. Retailers, manufacturers, even tech firms obsess over this because liquidity isn't optional, it's oxygen. Then comes the most visible decision of all: what to do with profits. Some companies return money to shareholders regularly, others keep it and reinvest aggressively. Neither is right by default. The right decision depends on growth opportunities, risk, and investor expectations. This is why mature firms behave differently from fast-growing ones. Stability rewards consistency, growth rewards reinvestment. And here's the unifying truth behind all of it. Corporate financial management exists to maximize long-term value, not chase short-term headlines. Share price, returns, and confidence all follow disciplined decisions, not lucky guesses. Modern finance has added new tools to the mix. Data analytics, AI, global capital markets, and currency risk management now shape decisions at speed. But the logic underneath hasn't changed. Raise funds wisely, allocate capital intelligently, control cash relentlessly, reward investors responsibly. Much of this thinking was formalized in modern finance by economists like Franco Modigliani and Merton Miller, whose work shaped how companies think about capital structure and value, principles still debated and applied today. In the next video, we'll move into investment analysis and risk management, how companies decide which projects are worth betting on and which risks should never be ignored. Subscribe and continue with the playlist. This is the Learning Studio. I'll see you in the next lesson.